A man won a Nobel Prize in economics for basically telling you what I'm about to tell you now. Now, I've written about all of this in my 18-odd books published by the Financial Times, my 200 Financial Times columns, and my Bloomberg TV shows as well. So let me tell you what the major problem with funds is. And I'm only repeating, actually, the research of Eugene Fama, Richard Thaler, and Daniel Kahneman, amongst others, who've won the Nobel Prize in economics. Two of those were psychologists, by the way, they weren't even economists. So I thought, look, instead of going through individual funds, I'll just go through a whole bunch of them from HSBC Asset Management. Why did I pick HSBC Asset Management? Because somebody emailed me who held, amongst other things, Fidelity Index World, Vanguard Life Strategy, HSBC Global Strategy Adventurous, BlackRock Pacific, BlackRock iShares UK, Fidelity Index, and BlackRock Collective. So I thought, well, okay, I'll deal with BlackRock separately and have a fight with them separately, and Vanguard separately, and Fidelity. For now, let's kick off with HSBC. And I'm just going to run through their funds. And basically, this quick run through will actually show you what the problem is. 3 years annualized, okay? So per annum returns. Yeah, one or two which weren't too bad. But then again, oh, that's American. Okay, well, if you're going into American, then I'm afraid 14% isn't good enough, because last year the NASDAQ was up 55% and the S&P was up 25 anyway. But the rest of them, bloody hell. And your IFA and wealth manager won't just put you in one fund. They will want to spray and pray like crazy into a lot of funds. So I'm just going to start off with the 3-year annualized, okay? And you can look at the 5-year at the same time if you wish. Look at most of these. That's below a bank account, okay? Don't talk to me about the 1 year. We just had the biggest 1-year bull market run pretty much since 1945, okay? Which is one of the greatest big stock market run-ups last year. I'm talking the American, which, by the way, is not close to you, not closed off to you. So don't think, well, why are you looking at that? Okay, because I like to make money. I want my pension to make money. I like my money working hard, and I don't like to work hard. That's why I look at that one. Well, don't look at that. Why don't you go work down the pit instead and just work really hard? No, I like to make money. 3 years, annualized 2.97, negative 1.67. Great. And you know what that is? Global sustainable, multi-asset. Cautious. You're cautious and you're losing money. That doesn't look like caution. That looks like crap. 0.53, sustainable. If I hit a bloody Greta Thunberg talking about sustainability has its place. That place is everywhere else outside of my bloody pension. Minus 6.8, Asia Pacific, excluding Japan. Asia Pacific, which great IFA. And I'm not saying, oh, well, they don't have a crystal ball. They didn't know Asia Pacific wouldn't do so well. Well, Bora Bora ain't going to cut it for me, is it? Right? Should be pretty obvious. Where's innovation coming from the world? I'll let you into a little secret. Here's some data which is widely available on something called the internet. The GDP growth of a country is directly proportionate to the intellectual property it produces. In other words, number of patents it issues each year. There's a high correlation. Asia Pacific, many patents being issued recently. I don't owe them a favor, and nobody owes me a living either. Okay, I'll do them a favor when they give me a living. 1.83%, 2.36, minus 5. Now, your IFA is going to pick through these, especially if they're tied to HSBC. And by the way, I'm not just picking on HSBC. It could be any multitude of managers. Oh, almost got a good one there. Euro Stocks 50. That is an exchange traded fund, which is an index tracker. Great. So guess what does well? The non-active one, the one which is just autopilot. Good. That's not too bad. But again, well below, I mean, most people will take that, well below 55% last year alone on the NASDAQ. And so they've got lucky because of a recent rise. Now, FTSE 100, 5.29. That's not even going to cut inflation. Okay, 0.69 over the last year. And this is the problem. You might look at the 5-year and think, oh, it'll be all right. They just had a bad year. Go on, let them. No, because if I have a year like that in one of the largest bull markets, I'm sorry, no, it's my money. I want high positive returns every single year. The only time I'll accept a negative year or a 0% year is like 2022, where we just ended up having to hold cash. Then I'll say, okay, and even then I'm discounted how much we earned on the cash. Then it's fine. Minus 13. And this is the other problem. They're selecting from this pool. What makes you think they're going to select out of these? right? The ones which have done well, they're going to pick a whole load of these. 3 years annualized, -3%, -0.78, -2. Okay. Now, some of these aren't equities, they're bonds, and you might say, well, you shouldn't pick bonds and select them with equities. I'm not doing that. Your IFA and wealth manager is going to do it. All right. And you might say, well, you're just cherry picking the bad. No, I'm not. I'm scrolling down a bloody list. Right. Okay. So let's have a look. -3.99, global real estate equity. So that's given me over 1 year negative returns, over 3 years. Oh, but Alpesh, you've got to diversify across different asset classes. That's what diversification means. It means when one thing goes up, the other thing goes in the opposite direction. That's the definition of diversification, okay? Non-correlation of assets. Actually, ideally what you want is zero correlation, but what you end up often getting is negative, opposing correlation, hedging in other words, which means you make money on one and you get a drag and a loss on the other. They don't understand that subtle difference. So they shove you in a bit of real estate because they think you're diversified now. Well, you just lost money. Oh, yeah, but you made it on the other one. That's diversification. No, it's actually lack of correlation is better, is what diversification is. And by the way, William Sharpe, I think he also got a Nobel Prize in economics for creating the Sharpe ratio to show which, separate to the Sharpe ratio, the correlation effect shows, and that was down to Sharpe as well, if I'm not mistaken. India fixed income. Okay. Oh, what's that? Turkey. There you go. Well, all right. You could have a weird economy like Turkey. I say weird, esoteric. 22% annualized. 37% over 3 years. Yeah, that I'd take that. That's pretty good. Who's got big balls to put their money into that for next year then? You up for it? I'm not. Thanks very much. And I bet your IFA didn't put you into Turkey either. Put your hands up if they did. Oh, we got another one. US equity index. Well, US equities. So there, which proves the point of what I'm saying. -27%. Hang Seng. Tech? Yeah, but Hang Seng. Okay. Hang Seng. You know what Hang Seng is? Hong Kong. Right. So you've got to put it into Hong Kong. Do you know anything about what's happening in the world in China and its relationship with Hong Kong and how many companies are leaving the Hong Kong market? I've got a friend. He's a mentor of mine. He sits on the board of the Hong Kong Stock Exchange, and his name's Apoorv Bagri. His father used to be chairman of the London Metal Exchange. The Hang Seng is not a place I would want to put my money. Let's see. Over 1 year, it's down 13%. Over 5 years, it's down 41%. I mean, don't get me wrong. He's a shrewd bugger. He'll have wanted to do a merger probably with the London Stock Exchange, if I know him well enough. And he'd be advocating that on the board. There's always money in mergers. Right. Latin America, not too bad, but over 5 years, just 2%. And honestly, Latin America, I would be scared as well. So you see Turkey's come up again. What about individual countries? It's just too risky. I mean, Mexico did well. Do you really think, with a straight face, I'm going to say to you, with Mexico, and I mean, if I say Mexico, I might as well say Korea. No, I can't do that. I can't do those. So what do you end up with? 0.48, Advant Edge fund. Do you see what they did there? Somebody clever in the marketing department at HSBC. Let's call it the Advantage fund. Yeah, 0.48% per annum for 3 years. Per annum, okay? Let's see, what else you got? Corporate bonds. Now, bonds. People say, I know, I'll put some money in bonds because I want safety. Corporate bonds should give a better yield than sovereign bonds, obviously, than country bonds. Well, yeah, over 1 year, 5.27%. I get 4.99 over the past year. 3 years, minus 3.9. Why? Over 5 years, you've got zero return. Why have you got that in bonds? Because they're usually not measured yield to maturity. You're not holding to the end. You're trading in and out of them. So if that fund has been trading in and out of them, yeah, they've shafted your pension there. Anyway, I'm sorry, the 10 minutes are coming up. I'll try and come up with solutions of what to do other than try and do it yourself, which is what I'm about. Have a look at my campaign for $1million.com to teach people how to improve. Well, at least not just improve their pension, but at least know what questions to ask their fund managers. Which one of these are the genius going to pick? Okay, thank you.